Zimbabwe's hyperinflation showed how quickly an economy can collapse when confidence disappears. During the 2000s, the government printed large amounts of money to cover debts and public expenses. At first, people hoped it might restore stability, but prices soon doubled every day. By 2008, inflation became so extreme that banknotes reached trillions. A single loaf of bread could require piles of cash taller than a person. Savings evaporated, banks failed, and shops constantly changed prices. People spent wages immediately to avoid losing value. Basic goods dwindled, and daily life became a struggle to keep up. Many carried bags of notes for simple purchases. Eventually, Zimbabwe abandoned its currency and adopted foreign money. This brought calm back. Part 2. Argentina's Currency Peg. In the 1990s, Argentina aimed to stop hyperinflation by tying the peso to the US dollar at a 1-to-1 rate. At first, the plan restored stability, boosted confidence, and drew foreign investment. However, the fixed exchange rate made exports expensive and imports cheap, hurting local industries. As debts grew, defending the peg became impossible. By 2001, the economy collapsed. Banks froze withdrawals, unemployment surged, and protests erupted nationwide. Families lost savings overnight as the system buckled. Businesses shut down, and political turmoil spread. Trust in institutions fell sharply, and poverty increased across the country. The crisis reshaped Argentina's economic identity and remains a warning for rigid currency systems. Part 3. Soviet price controls. The Soviet Union enforced strict price controls for decades, believing that fixing the cost of food, housing, and everyday goods would create fairness and stability. Instead, the lack of real market signals caused huge shortages across the country. Factories kept producing items no one needed, while essentials like meat, shoes, soap, and medicine often vanished from stores. Long lines formed before dawn, and ration coupons became a normal part of life. Many citizens relied on black markets just to survive. By the 1980s, the gap between official prices and actual demand grew impossible to manage. Shelves emptied, productivity collapsed, and frustration spread nationwide. The system's failures became a major force pushing the Soviet economy toward eventual breakdown. Part 4. Iceland's banking collapse. Iceland's banking collapse became one of the most dramatic financial failures of the 2000s. During the early decade, its small banks expanded at an astonishing pace, borrowing heavily from foreign lenders and investing in risky assets. Their combined debts soon grew several times larger than Iceland's entire economy. When the 2008 global crisis struck, confidence vanished instantly. All major banks failed within days, the currency plunged, and many citizens lost access to savings. Businesses struggled to operate, unemployment rose, and the government imposed strict capital controls to prevent total financial ruin. The disaster revealed how dangerous rapid, unregulated growth can be for a small national economy. Part 5. India's Demonetization. In 2016, India carried out a sudden demonetization, announcing that its two most widely used banknotes would lose all value overnight. The plan aimed to fight corruption, illegal cash holdings, and counterfeit money. Instead, the shock created nationwide chaos. Nearly 86% of the country's currency disappeared instantly, forcing millions to stand in long bank lines to exchange old notes. Small shops struggled to operate, daily wage workers lost income, and rural areas faced severe cash shortages. Many families were unable to buy medicine or basic goods during the transition. Digital payments increased,
But the economic disruption slowed growth and raised questions about whether the dramatic move achieved its intended goals.
Part 6. Greece's Austerity Crisis. Greece's austerity crisis began in 2010, after years of hidden deficits, overspending, and false reporting left the country buried in debt. To receive bailout funds, Greece had to impose strict austerity, wage cuts, tax hikes, pension reductions, and limits on public services. Instead of restoring stability, these measures pushed the economy into a deeper recession. Unemployment soared above 25%, youth joblessness neared 50%, and thousands of businesses closed. Public frustration erupted into nationwide protests and strikes as living standards fell. The crisis reshaped Greece's politics and became a warning about the risks of extreme austerity during collapse. Many young people emigrated abroad for work, leaving painful scars on society.
Part 7. Venezuela's currency collapse shows how quickly money can lose value when a government keeps printing to cover its bills. After oil prices crashed in 2014, state income fell sharply, yet spending continued, so the central bank flooded the economy with new bolivars. Inflation soon exploded, erasing salaries, pensions, and savings. Shops ran out of food and medicine, and basic goods cost millions of notes. People hauled bundles of cash just to buy bread, while many families fled abroad. Over time, dollars and other foreign currencies replaced the bolivar in daily trade, turning Venezuela into a warning about uncontrolled money creation. Everyday life became a struggle to find goods, and trust in the currency collapsed. Many who stayed faced poverty.
Part 8. Japan's negative interest rates. Japan's experiment with negative interest rates began in 2016, after decades of weak growth and low inflation. The central bank pushed some rates below zero, hoping banks would lend more and households would spend instead of saving. Yet the policy squeezed bank profits and made saving less attractive without restoring real confidence. Many firms still hesitated to invest, worried about aging consumers and slow demand. Ordinary people saw tiny returns on deposits and grew cautious. Critics argued that negative rates signaled desperation. Japan's experience suggested that without deeper reforms, cheap money alone cannot revive a tired economy. The policy turned Japan into a case study for central banks worldwide. Results stayed unclear, and doubts grew. Part 9. China's Ghost Cities. China's ghost cities emerged from an aggressive push for growth, driven by construction and easy credit. Local governments and developers borrowed heavily to build entire new districts filled with apartment towers, highways, and shopping malls long before residents arrived. These projects boosted GDP statistics and created jobs, but demand often failed to match supply. Many complexes stood nearly empty, with lights off at night and unfinished buildings gathering dust. Investors who bought apartments as speculative assets struggled to find buyers or tenants, raising concerns about mounting debt and wasted resources. The phenomenon exposed the risks of chasing growth through building. It showed how cheap credit and bad incentives can inflate property bubbles. Part 10. The Eurozone Debt Storm. The euro was created to unite European economies under one shared currency, making trade and travel easier. But members kept different levels of productivity, wages, and debt. When the 2008 financial crisis hit, weaker countries like Greece, Portugal, and Spain could not devalue their currencies to regain competitiveness. Instead, they faced soaring borrowing costs and strict budget rules. Unemployment rose sharply, especially among young people, and public anger grew. The crisis exposed how a shared currency without full political and fiscal union can deepen imbalances during hard times. Bailout fights and austerity strained ties between northern countries and southern ones. The euro survived,
But the crisis left scars and raised doubts about union.